I'm Mike Drutar, principal broker and owner of NextHome Paradise Realty in Kona, Hawaii. And today we're going to talk about inflation and how inflation impacts real estate. If you like this video and you find it helpful, it'd mean a lot to me if you could give me a like and subscribe to my channel. Really would appreciate it. So starting in March of 2020 with the CARES Act and continuing still today, the federal government has pumped more than $6 trillion into the economy to deal with the current economic situation. And in case anyone wants to blame one political party or the other, I will point out that the CARES Act passed a Republican-controlled Senate unanimously, a Democratic-controlled House by a voice vote, and was signed into law by a Republican president. So both parties clearly have their fingerprints all over this one. Almost from the beginning, people have been talking about the impact of all that money entering the market and the potential for inflation, something that we have not seen in a really long time. So quick note, I'm not an economist, I'm not an investment advisor, I'm not licensed by the Securities and Exchange Commission to give you investment advice, and I'm not attempting to give investment advice here. I'm giving you my opinion on the situation we have now and how it relates to real estate and some strategies that some people use to deal with inflation. The time for all that postulating about inflation has come to an end as the consumer price index rose over 4% in April, which was the highest since 2008. And now that inflation is here, the question for a lot of people is, how will it impact real estate? The first thing we need to do is explain exactly what inflation is. Inflation is the rate at which a value of a currency is falling, and consequently the general level of prices for goods and services is rising. So if an orange costs you $1 in April of 2020 and we had 4% inflation in April of 2021, that same orange in theory now costs you $1.04. So that dollar you had in 2020 now buys you less of that orange, which is to say that the value of your dollar went down or the price of a good went up. It's really the same thing. The next thing I need to explain is how inflation is calculated. Generally, when you see inflation numbers, they are looking at the Consumer Price Index, or CPI. The CPI is a measurement of a basket of different goods and services and how those prices change over time. With 8 major categories, including housing and food, medical care, transportation, and others, it represents a really wide array of items. It's important to note that some commodities may see drastically higher inflation for various market reasons. Lumber is a really good example right now. Demand is up due to new home construction and home improvements. Tariffs on Canadian lumber add to the cost, while at the same time, supply-side problems, which largely exist because of what we've gone through in the last 14 months, have made it so that the prices of lumber have skyrocketed. And while the Fred report shows a doubling in prices in many areas, like here in Hawaii, the price of a 2x4 has more than tripled. Now, I'd be remiss if I didn't issue a small caveat here. It's important to note that while we are talking about inflation now, there's really no clear consensus as to if this is the beginning of a long cycle of inflation, if we're going to see some hyperinflation, or if this is actually a short-term issue because of those supply-side problems like we mentioned with the lumber. Some feel that the markets will balance themselves out when the supply chains catch up to the current market demand. Okay, so if we do think we have inflation happening now and happening on down the road, what does that mean for us? Well, first and foremost, as we illustrated with the $1.04 orange, your dollars would be worth less than they were before. We can work that the other way with more money over time to show how prolonged inflation can erode the value of currency. Let's say you had $10,000 in cash in a shoebox or in a bank, since they pay about the same rate of return these days, and you were to buy $1 oranges. You would be able to buy 10,000 oranges. Now, if you had waited 5 years with 4% inflation, at the end of that 5 years, your $10,000 would only buy you 8,219 oranges. That's how the inflation over time can have a significant impact on the buying power of the dollar. In the end of that 5-year period, you actually lost purchasing power by saving your money. The moral of the story, don't hold cash if you believe we will have inflation. Turn your cash into an asset and hold on to the asset, which you can turn into more cash later on. Some people have a tendency to just hold on to their cash when there is economic change. That's just the wrong play if you think we're in for an inflationary cycle. Anyone concerned about inflation should be acquiring long-term assets. Now that covers the common definition and index which measures inflation along with an example, but there's another thing that we need to talk about at a macro level, and that is to understand the amount of cash just floating around in the market. Believe it or not, there is a measurement for that, and it's called the M2 money supply. M2 is a measure of the money supply that includes cash, checking deposits, and easily convertible near money like savings deposit, money market securities, and mutual funds. An increase in the amount of M2 money supply is considered an early predictor of inflation. With people having more money, they buy more things. The people who have the money to buy those things compete with one another for that item, and the price goes up. That's inflation. The M2 supply before things changed last year was $15.4 trillion. After all the economic stimulus cash being pumped into the market, that stands at almost $19.9 trillion in March of 2021 for an increase of over 27% in just 13 months. That's more than double the next greatest increase of money at any time since the measurement began in 1959. And it's because of this that the alarm sounded about inflation from the beginning way back in April of 2020. Some think we are seeing inflation going up now because people are finally leaving their homes and buying things again with all that money that they have. So let's go back to that orange and let's substitute oranges for real estate. If a $500,000 house went up in value 4% a year for 5 years, would you have been better holding on to that $500,000 in cash for the house, or would you have been better off with the house? Well, like we established with the oranges, you would have been better off with the house. However, while oranges are temporary, real estate is a long-term asset with some pretty special qualities. Unlike that orange, it does not spoil very fast, and unlike gold or silver, you can actually let someone else use it for a while, give you money for that use, and then have them give you back the asset in the end. And it's because of this that some people feel that real estate is the best hedge against inflation. Not only do you get to enjoy the appreciation and value, but you put your money into a rental property, you can even have cash dividends in the form of rent collected. Additionally, inflation has other added benefits for landlords. With more money in circulation, renters have the ability to compete with one another, driving up rent prices. This is also why you saw a big decrease in the stock market after the inflation report of April came out just a couple of weeks ago. Many investors pulled some money out of cash and cash equivalents like stocks and switched it over to various hard assets. Understand that if you really think inflation is coming and it's a big deal, you should be doing everything you can to convert that cash into a tangible asset that can be exchanged for more cash later on. So what happens after we have many months of inflation? Well, theoretically, the Federal Reserve would raise interest rates to slow down the rate of spending. That would have yet another benefit for landlords. As interest rates go up, more and more potential buyers will be unable to qualify for a mortgage and will have to rent instead, leading to even more competition among renters, which again means higher rental revenues. We can look at a real-world example in the real estate market right now to see how substitution and competition play out. Right now, the cost of lumber is at an all-time high. As a result, the cost of building a home has exploded. Lumber costs have more than doubled. Right now, I'm hearing stories of people whose construction costs are going up by more than 50% from just a few months ago due to lumber and concrete and labor costs. As a result, even though prices are going up, we are seeing new home starts going down. Builders are not sure they will be able to pass on these costs to the buyer. Some builders are even going so far as to pour the foundation and then waiting for lumber prices to come down to finish construction. That ends up being yet another restriction on housing supply. In short, the inflationary cost of building has limited the supply and is driving up the market to the substitution product of existing homes, contributing to drive up those prices as well, even though those existing homes do not need any new lumber. And another incredible benefit about real estate is that unlike gold or silver, you can actually use someone else's money to buy the commodity. You'd be really hard pressed to find someone willing to lend you $750,000 to buy $1 million in gold. But they are willing to lend you $750,000 to buy $1 million in real estate. We can even math out how the ability to leverage this debt in an inflationary market can easily be a smart way to build wealth. Let's say you put $250,000 down on a $1 million purchase. During a 4% inflationary cycle of 5 years, at the end of the 5 years, your property would be worth $1,216,652. So you would have profited over $216,000 while only risking $250,000 for a return of 17.3% per year. That guy who had to come up with $1 million in cash to buy $1 million in gold, well, he just made the 4% per year over time. And we've not even accounted for the fact that rental returns may have covered the cost of the mortgage, the tax benefits of writing off the interest on the loan, or depreciating the investment real estate. Even if you bought that house house for $1 million in cash, you would still get the 4% return in price inflation plus all the rental income. With real estate, you have the ability to outperform inflation whether you borrow or pay cash. And we're currently seeing that housing prices are going up much higher than the rate of inflation. But here's the really amazing thing about right now. We are in an unprecedented sweet spot for being able to borrow money at a low rate while enjoying the benefits of inflation if we are properly positioned. So far, the Federal Reserve has not raised interest rates and the borrowing markets have not really adjusted upwardly. Right now, you can borrow for less than the rate of inflation. If inflation's 4%, but your loan is 3%, you're basically being given 1% to borrow money. It really is pretty amazing. And the best part of all, if we go hyperinflation for a while, say 8%, that 3% loan is locked in. It's a really great time to borrow, but this is not the time for an adjustable rate mortgage. If someone tries to get you to an arm, you need to run away. I hope this video has been helpful for you in understanding how you can protect and even thrive in an inflationary market. If you like this, please give me a thumbs up and subscribe, maybe even share it with a friend, and also be sure to check out other videos that I have. See you soon.